It is Wednesday, February 4th, 2026. Welcome back to Talk Tickers. We have the transcripts, we have the analyst notes, and honestly, we have a very confused-looking algorithm on our hands today.
Oh, yeah.
We're looking at Phillips 66, ticker PSX.
Yeah, this is definitely one of those days where the headlines just do not match the price action. At least, not if you only look surface deep.
Exactly. I mean, if you were just watching the ticker tape, you'd think they announced they discovered cold fusion or something. The stock closed at $154.69. That is up almost $6.50, a 4.4% jump in a single trading session. But, and this is a big but, they missed revenue.
Oh, yeah.
And they didn't just miss by a rounding error. They missed by $2 billion.
It's a massive gap, a huge gap.
So that is our mission today. We need to figure out why the market is popping the champagne when the top line number looks like a bust. Is this just, irrational exuberance? Or is there something hidden in the machinery of this company that actually justifies the rally?
It is the latter, 100%. The market is buying a story here. Management is calling 2025 a pivotal year. And look, usually when I hear corporate leadership say pivotal year, I kind of roll my eyes.
Right. It usually means they're restructuring after a disaster.
Exactly. But in this case, the market believes them. We are watching a company try to fundamentally change its DNA from a traditional cyclical oil refiner into a diversified energy logistics machine.
A logistics machine.
Yeah.
I want to get to that definition because it sounds a lot more stable than just refiner. But we have to clear the air on the numbers first.
Yeah.
Because noisy is putting it lightly.
It was a very messy quarter for the accountants, that's for sure.
Okay, so let's look at the earnings per share. The GAAP number, the headline number that shows up on all the generic news feeds, was a massive $7.17. Now, normally, if an energy company posts $7.17 per share, the stock goes to the moon.
Right. And if you just glanced at that, you'd think they, struck a gold mine underneath a gas station. But we have to put a giant flashing neon asterisk next to that number. That $7.17 is totally distorted by special items. You absolutely cannot model the future of the company on that number.
Why not? Where did all that money come from?
Two main buckets. First, the influx of cash. They sold a 65% interest in their retail marketing business over in Germany and Austria.
Okay, so a one-time sale.
A one-time sale that brought in a mountain of cash. But on the flip side, they took a massive accounting hit. It's called accelerated depreciation because they made the hard call to idle the Los Angeles refinery.
Okay, so you have a one-time windfall from selling off gas stations in Europe and a one-time write-off from shutting down a huge plant in California. Neither of those are business as usual. So if I am a serious investor and I strip all that out, what's the actual health of the business?
Then you have to look at the adjusted EPS. That came in at $2.47.
And the street was looking for?
The consensus on the street, what all the big banks were expecting, was $2.25. So despite all the noise, this is a solid beat. They beat expectations by about 22 cents.
Okay, so they beat on profit, but I'm going back to the revenue. They brought in $32.14 billion.
Yeah.
The street wanted $34.14 billion. That is a $2 billion hole in the top line.
Yeah.
Usually you miss revenue by $2 billion and you get punished. Why did they get a pass?
Because in the energy sector right now, revenue is vanity and cash flow is sanity. The market looked right past the revenue miss because the cash conversion was just incredible. Operating cash flow was $2.752 billion for the quarter.
Wow.
And even if you exclude working capital changes, so just the raw cash generated by the business operations, it was still over $2 billion.
So the argument is, who cares if we sold less stuff? We kept way more of the money.
Precisely. And they aren't just sitting on that cash like a dragon on a gold pile. They are handing it back. In the fourth quarter alone, they returned $756 million to shareholders.
Through dividends and buybacks.
Dividends and buybacks. It's a serious payout ratio.
Yeah.
And if you zoom out and look at the last year, PSX is up about 28%. Compare that to the Energy Exploration ETF, XOP, which is actually down slightly over the last year. So Phillips 66 is significantly outperforming the broader energy basket because they're proving they can generate cash even when that revenue number looks a little light.
Let's dig into how they're doing that, because you don't generate that kind of cash by accident, especially when you're shutting down refineries. This connects to that whole pivotal year theme. They keep talking about a culture of ownership, which sounds nice, but I want to know about the nuts and bolts.
The biggest story is in the engine room, refining.
We mentioned the LA refinery. So management made the call to idle it. That's a huge decision. It's tough for the workforce, obviously. But from a business perspective, explain the logic there. Why shut down a massive asset?
It's addition by subtraction. The LA refinery was a high-cost asset. California is an incredibly expensive place to do business.
Regulatory costs, electricity, labor.
Everything. Environmental compliance. It was a drag on the whole system.
So it was just eating the profits from their other more efficient refineries.
Exactly. By taking it offline, they remove that drag. They estimate that removing that single asset improves their annualized cost structure by about 30 cents per barrel across their entire global system.
30 cents a barrel. I mean, to the average person, that sounds like pennies.
It sounds small until you realize they process nearly 2 million barrels a day.
Right.
That 30 cents is millions and millions of dollars of pure margin falling straight to the bottom line. It's massive. They have a target to get their adjusted controllable cost down to $5.50 per barrel by the end of 2027. This LA decision gets them a big chunk of the way there.
But they aren't just cutting, right? I saw something in the notes about 2025 being their best year ever for safety. Now, I'm cynical. Usually when companies talk about safety, it feels like PR fluff. But in this industry, does safety actually equal profit?
In refining, absolutely. 100%. Think about it. What costs the most money in a refinery? It's not the crude oil. It's when the plant stops running.
Unplanned outages.
Exactly. If something breaks or there's an accident, you stop making product, but you still have to pay all the bills. A safe plant is a reliable plant, and a reliable plant is a money printing machine.
Okay, that tracks. But here is the thing that really caught my eye in the report. It's what I call capacity creep. We usually think about growth in this industry as, building a massive new factory, but nobody builds new refineries in the U.S. anymore.
Nope.
So how are they growing capacity if they aren't building new plants?
They are squeezing more juice out of the orange they already have. The technical term is debottlenecking.
Debottlenecking. I love that word. But let's break it down. Explain that like I'm 5 years old. What are they actually doing?
Okay, imagine a highway. It's rush hour. The highway is jammed. You can't afford to build a whole new highway next to it. But you realize that one specific on-ramp is causing everyone to slow down. If you just pave that on-ramp to be a little wider, suddenly the whole highway moves 10% faster.
So they're just finding the on-ramps inside the refinery.
That's it. Exactly. They aren't building new towers. They're upgrading a pump here, a heat exchanger there, optimizing flow rates. They increased capacity at the Billings refinery to 71,000 barrels a day. They bumped up Ponca City to 228,000 barrels a day.
And they did this at Bayway and Sweeney too, I saw.
Right. So when you add up all those little tweaks, fixing all those little on-ramps, they've added about 25,000 barrels per day of capacity across the system.
That's basically a free small refinery's worth of production.
It is, and it's added without spending the billions of dollars it would take to build it from scratch.
That is pretty clever. And they seem confident they can sell that extra product.
Yeah.
The guidance for Q1 2026 utilization is in the mid-90s. For the first quarter, which is usually maintenance season when things slow down, that feels incredibly high.
It signals high confidence. They believe the assets are reliable enough to run that hard. And more importantly, they believe the market demand is there to absorb the product.
So that's refining leaner, meaner, and running hard. But the pivot they talk about is really about moving away from just refining. They want to own the whole chain. We need to talk about midstream.
This is the growth engine. And it's also the stabilizer. Refining is volatile margins blow out, then they crash. Midstream pipelines, storage, fractionation, that is steady fee-based income. It's like being the landlord instead of the retailer.
Okay.
They're targeting a run rate adjusted EBITDA of about $4.5 billion in the midstream segment by the end of 2027.
$4.5 billion is a massive number for what's essentially a boring logistics business. What's driving that growth? Is it just moving more oil?
It's actually NGL's natural gas liquids, things like propane, butane, ethane. They are seeing record volumes for transportation and fractionation.
Hold on. Fractionation. We see this word in every PSX report. I know it's important, but what is physically happening there?
Sure. So when natural gas comes out of the ground, it's not just one thing. It's a high-grade mix. It's like a soup of different hydrocarbons. Fractionation is the process of separating them out. You heat up this soup in a big tower. And because propane boils at a different temperature than butane, and butane boils at a different temperature than ethane, they separate out into layers.
Well, like distilling alcohol.
Exactly like distilling alcohol, but on a massive industrial scale. You split the raw mix into pure streams, which are then sold for heating, plastics, or export. PSX is huge in this space, and the demand for these liquids globally is skyrocketing.
And they're building the infrastructure to handle even more of it.
Right. They have the Coastal Bend expansion coming online late in 2026, which adds 125,000 barrels a day of that fractionation capacity. They have the Iron Mesa gas plant coming in early 2027. They mentioned they're adding a new gas plant roughly every 12 to 18 months in the Permian Basin.
That's a relentless pace.
It is. They're basically betting the house on the continued dominance of U.S. energy production.
But there's one project that I think really ties the refining strategy and the midstream strategy together. It's this Western Gateway pipeline.
This is my favorite part of the strategy. It's honestly brilliant.
Let's unpack it. Because we just said they shut down the LA refinery. So why on earth are they building a pipeline extension called Western Gateway into a market they just exited?
This is the genius of the pivot. Think about it. When you shut down the LA refinery, Los Angeles doesn't stop driving. It's one of the biggest fuel markets in the world. But now, they can't make the gas locally. So, where does it come from?
You had to import it.
Exactly. Or you bring it in from your other refineries that are much cheaper to operate. The Western Gateway is an extension that will allow Phillips 66 to take product from the Gulf Coast and the Mid-Continent, where crude is cheap and electricity is cheaper, and pipe it directly into the LA market.
So wait, they turn a refining headache operating a factory in highly regulated California into a logistics profit center.
Yes. They convert from a manufacturer in a high-cost environment to the toll road owner supplying that environment. It's a complete flip of the business model for that region.
That is fascinating. It's like they're acknowledging, we can't make the pizza in your neighborhood efficiently anymore, so we're just going to become the exclusive delivery service.
And in a market as geographically isolated as California, being the delivery service is a very, very powerful position. You capture the margin without the regulatory headache of running the smokestack.
Let's zoom out to the macro picture. We can't talk about Gulf Coast refining without addressing the elephant in the room. Venezuelan crude, back in the mix. How does that impact a company like PSX?
It is fantastic news for them. You have to remember, Phillips 66 has a very complex refining kit. They can process about 250,000 barrels a day of that heavy, sludgy crude that Venezuela produces.
And most refineries can't touch that stuff, right? It would just clog the pipes.
Correct. It requires specific equipment cookers to break it down. It's like having a high-powered blender that can handle rocks. Because it's hard to refine, that heavy crude trades at a discount compared to the light, sweet stuff. This is the heavy differential, or the WCS spread.
WCS stands for Western Canadian Select, right? The heavy stuff from Canada.
Right. Heavy crude from Canada or Venezuela. It's cheaper than the standard oil. So the wider that spread, the cheaper the heavy stuff is, the more money PSX makes because they can buy the cheap stuff and still sell the gasoline at full price.
But what's the leverage there?
Management laid out the math for us. For every $1 change in that differential, meaning every dollar cheaper heavy crude gets, it's worth $140 million in annual earnings for them.
$140 million for a $1 spread change.
Yeah.
That is massive leverage.
It is. And with Venezuelan volumes returning and Canadian production ramping up, that differential is widening. It's a massive tailwind for their Gulf Coast assets. They are basically getting paid a premium to have the complex machinery that can handle the cheap, gross stuff.
So refining is optimizing, midstream is growing, macro is helping. What about chemicals? They own a huge stake in CPChem, and right now that sector feels like it's in the dumps.
It's definitely a cyclical low. Global demand for plastics is soft, but there's a survival of the fittest dynamic happening here. The U.S. assets, which run on cheap natural gas, are running at 90% utilization.
Wow.
Meanwhile, competitors in Europe and Asia who have to pay for expensive naphtha or LNG are running at like 65%.
So even though the market is down, PSX is gaining market share just by staying online.
Exactly. They are grinding out the competitors who have higher energy costs. And they have the Golden Triangle project starting up in Q4 2026, which will add even more capacity right as the cycle hopefully starts to turn.
Let's talk about the money. The CFO laid out this 8222 framework. It sounds like a soccer formation. What does it actually mean for the cash?
It's a mental model for their $8 billion in operating cash flow. Here's how they slice the pie. First $2 billion goes to dividends, secure and growing.
Okay.
The next $2 billion goes to CapEx, keeping the plants running and hosting those midstream projects.
So that leaves $4 billion on the table.
Right. And that remaining $4 billion is split between debt reduction and share buybacks. They are very focused on the balance sheet. Net debt to capital is currently at 38%. They want to get total debt down to about $17 billion.
And the interesting stat there was that at that level, the debt is basically covered by the non-refining businesses.
That is the key to the valuation.
Yeah.
They want the debt to be supported by the stable midstream and marketing cash flows. That effectively leaves the refining business debt-free. So even if refining margins go to zero, which they won't, but theoretically the company is safe, it de-risks the entire stock.
Sounds like they're building a fortress. Okay, we have covered the earnings beat, the transformation refining, the midstream growth engine, and the macro tailwinds. Now, we have arrived at my favorite part of the deep dive. This is the part where we take the data we just discussed and we spin it into a trade idea. But first, the disclaimer. This is not financial advice. We are just two voices in your headphones. Do your own diligence. Do not blame us if you lose your shirt.
We are just exploring the logical extremes of the thesis here.
Exactly. So imagine we are analysts pitching to a hedge fund investment committee. I am calling this trade idea the California squeeze, or maybe the Western Gateway long.
I like the sound of that. Walk me through the pitch.
Okay, here's the setup. California refining is dying. We just saw PSX idle the LA refinery. Others are closing too. The regulatory environment is impossible. But people in LA are still driving. They still need jet fuel at LAX.
So demand is sticky, but local supply is crashing.
Right, so Supply Demand 101 says the premium for fuel in Los Angeles is going to skyrocket. It's going to be the most expensive market in America. Who wins? The guy who owns the bridge.
Or in this case, the pipe.
Exactly. The thesis is you go long PSX, not as an energy trade, but as a real estate logistics monopoly.
Yeah.
The Western Gateway pipeline is the straw that drinks the milkshake. They're going to pipe cheap Gulf Coast gasoline made with cheap Permian crude and cheap natural gas straight into the high-priced California market.
You're basically arbitraging the regulatory environment of California against the efficiency of Texas.
Yes. And PSX is the only one building the infrastructure to do it at scale. You are buying the toll road into a walled city that is running out of supplies. It's outrageous. But the math on those logistics spreads could be incredible.
It is a compelling narrative. It takes the midstream growth bullet point and turns it into a strategic stranglehold on a major economy. If that pipeline comes online and California prices spike, PSX prints money.
And that is why we do the deep dive.
Huh.
To find the story behind the 8K.
And if that Western Gateway project executes on time, that logistics profit center we talked about becomes a massive cash cow.
All right, let's wrap this up. Recap for the listeners.
Solid quarter. They beat on adjusted EPS despite the noisy revenue miss. They're aggressively managing costs down to that $5.50 target. Midstream is growing toward that $4.5 billion EBITDA number. And they're returning a mountain of cash to shareholders, $756 million in just 3 months.
Management ended the call by saying the best is yet to come. And judging by that 4% pop in the stock price, the market seems to believe them.
They've got momentum, now they just have to execute.
Let us know what you think. Is the California squeeze trade genius, or are we crazy? You know where to find us.
Until next time.
Talk Tickers signing off.